Thank you, Michaela, and thank you all for joining us today. As Michaela mentioned, my name is Ayça, and I'm the Regional Ferrous Scrap Market Specialist at SteelOrbis. I will share a small presentation with you today about Turkish scrap market, but we have very limited time, so we will not have a Q&A session. I will share my contact information at the end, so if you have any further questions, please feel free to reach out. Throughout this year, I remember talking with several Italian colleagues, and we were talking about high inflation rates, tight monetary policies, lack of steel demand, and slowing manufacturing paces, of course, profits and capacity utilization rates. It was not much different in Turkey, and this graph, I think, will explain it further. This is Turkish Mill's electric arc furnace-based rebar export margins, and we can easily see that the greater margins we recorded in 2023 are simply not there in 2024. Especially as of May, we can see that the margins tightened up to very drastic levels. They are now recovering. In September, they more than doubled to $15 to $19, and we expect it to continue like this in October. However, it's important to understand what happened in June and July period. You can see here, Turkish mills were hesitant to buy scrap in June and July. Obviously, the lack of demand was a factor, and there were price uncertainties and high volumes of billet imports. In August, our deep-sea scrap prices declined, so it was time for Turkish mills to replenish their stocks. Procurement increased, and we can see it in the prices. Still, Europe is the biggest supplier of Turkey, with 67% of a share. Before we continue with scrap, I want to talk a bit about billets and slabs. Because in the first half of this year, Turkish mills actually increased their slab capacity utilization rates. There was little alternatives in the other markets, no cheaper allocations available for Turkey. So they just increased their own capacities and they met with the local demand. However, as of June, we can see that Turkish mills started to lower their capacity utilization rates for semi-finished products. By the third quarter, slab rates were 67 to 73%, billet rates were 60 to 62%. Actually, in July, 20% increase in electricity spot market tariffs happened in Turkey and worsened the challenges for Turkish mills. And over the past few months, prices for imported billets have dropped below production costs, contributing to reduced production rates. Turkey booked at least 500,000 metric tons of billets from Asia for October and November shipments. The total of billet imports for the last quarter of this year are evaluated by some at around 750,000 metric tons. Having shared some information about the semi-finished market, I want to look at the benchmark scrap price. As you can see, 80-20 scrap price in Turkey has remained in a very narrow range since April. The range was 375, 387 CFR Turkey. Actually, this relatively stable trend is very rare to see in Turkish market, and some players in the market wondered how this happened. Actually, we already talked about the lack of steel demand and inflation and slower manufacturing, but we also have to remember that these factors impact scrap collection pace and scrap collection costs. I remember last year around these times, European sub-collectors were telling me they have profited enough in the first 8 months of the year. So they were willing to slow their trading. They were to continue buying scrap for their own inventories, but they were planning to wait for higher prices before they sell their inventories. It happened at the end of 2023 as they planned, and earlier 2024, as you can see in the graph. However, this is not the case this year. Actually, there are concerns throughout all the supply chain about low to non-profits on the scrap collection side. So this narrow range happened because Turkish mills were exerting downward pressure on prices because they were failing to sell steel, but European scrap suppliers who, as we reminded in the previous slide, have a 67% of a share in Turkish market, were resisting that downward pressure. So prices remained at this range until August. Something changed in August, and it was the inventory levels of European suppliers. Since they found some alternative solutions for a while and waited for higher levels, their inventories increased to a point they needed to make a decision. They just decided they can accept lower bids coming out of Turkey at this point and drop the market from $387 to $358 CFR Turkey on average. We can see that the market price recovered very quickly, and I think we all wonder what will happen from now on. With Fed cutting interest rates and European Central Bank following it, and then China announcing some stimulus packages, we see that the sentiment in the Turkish scrap market is positive right now. After the recent price rebound in China, there have been some active talks of cancellations, at least 3 billet cargoes to Turkey, each 50,000 metric tons. If this is true, this might mean that these mills may be looking for higher scrap than they initially planned. And of course, if China's billet price sustains at quite a bit above 500 CFR Turkey, Turkish producers' interest in scrap might increase in the last months of 2024. Lastly, today we were waiting some signals coming out of China, and it's a bit controversial at this point, but maybe we can say for now the coming signals are not that bad and they can be considered positive. So we expect deep sea scrap prices moving up to 390, 395 CFR Turkey for now in the coming weeks. And for now, the demand in Turkish finished steel market supports this idea. As I said, I had too little time, and I think I have filled it, but please feel free to find me in the networking area. Thank you for your time.